Fund Supermart, your online gateway to unit trusts.
Right, so generally rising rate cycles are driven by, the beginning of them are driven by a rejuvenation of economic growth, which leads investors to demand more funds and causes an upward bias to rates. Eventually that starts to lead to some pricing pressure, so the investors will start pricing that into the yield curve. If we can just use the US, for example, as an example of how it plays out, you might first see a steepening in the yield curve where longer rates rise as investors start pricing in potential pricing pressures coming down the road. Eventually, the central bank will start to respond to that by lifting short rates higher, their policy rate. So they control the short end of the interest rate curve, and they'll start ratcheting that up. And eventually, they'll start to catch up to long-term rates, and eventually the market will forecast them as being ahead of the inflation curve, and the curve will then flatten and then eventually invert. This cycle is a bit different, though. I would just point out the main difference is we went through a very deep recession, the Great Financial Recession in 2008. And it's taken a long time to eat up the slack in the economy. So that pricing pressure has taken a long time to develop. Within the United States, which tends to set the global yield curve rates around the world, we're starting to see that we've shifted to that point where pricing pressures are just starting to show. And the Fed is already undertaking a very large rate hike from really starting in 2013 to the point where it's neutral. So we're getting towards the later stages of the interest rate cycle, and I would expect peak rates to be somewhere in the order of, say, 4% in the United States. That may take another 12 months or so to get to that target. So the current rate cycle really began in 2013, has been lifting up. The big change that we've seen recently is the Fed has gone from being very accommodative to less accommodative to basically neutral policy, which means they're not running policy too easy that will stoke inflation or too restrictive that will cause the economy to roll over. So you're, in some ways, you're a little bit in the sweet spot for yields and I would say even risky assets here, okay? At least in the US context. One of the key opportunities we think is, the beauty of this is that you've gotten higher yields. So one way is to extend out and then start to receive those higher yields or lock them in. And since we're close to the end of this cycle in terms of the adjustment in rates, now is the time to start thinking about locking in those yields, and we're close to it. So I think of, say, if you look at the 30-year US Treasury, we just touched recently 3.4%. If the upper boundary of that is somewhere around 4%-ish area, that we're pretty close. And instead of, when the adjustment was early in its stages, your current yield was like, say, 1% or so. Now you're earning 3+% carry. So the delta that we have in terms of moving from 340 to 4 is not going to be as painful as had it been carrying less a number of years ago. So that's the good news. In addition to that, I think within the U.S., there are still pockets of areas that provide pretty decent yield that have made the adjustment to higher yield so far in a pretty normal fashion, I would say. And they represent decent value. And one area I would say is U.S. high yield. There has been adjustment. The actual yields are 6+%. It's still pretty attractive. The fundamentals are solid. And we actually think the default risk, which is the big risk in that market, is actually quite low for a number of reasons on a look-forward basis. So we think that's an area that you can feel reasonably comfortable with. And there's a number of other credit-related pockets in the United States the same. Now, there are also risks in the market. and I think areas to avoid. And one area that has felt the pain from rising rates has not so much been obviously the U.S. economy, which has handled it just fine. It's been emerging markets and non-U.S. markets. And I still think it's a bit early to start to dip into those markets, but the price adjustment has been pretty severe. And I think it's getting close to, having at least pockets of opportunity to open up in the emerging market and non-U.S. developed economy space. Sure. So at Loomis Sayles, we always think it's a great idea, no matter what the environment is, to diversify your sources of return within fixed income. A lot of investors think of bond investing under one dimension. That's the interest rate risk and the yield from investing in bonds. And that's true if you're investing in a traditional fixed income that's tightly wound around some of the higher quality benchmark indices out there, like Barclays US Aggregate or Barclays Global. The ebb and flow of that in terms of returns and risk is going to be driven by interest rate risk predominantly. And we think that no matter what type of market, you should diversify away from that. This market today, and the rising rate that we've had, shows why that's a good idea. But it's true really in any environment. And that's because within fixed income, there are a lot of other premiums to invest in besides interest rate, term structure of interest rates. And those things could include credit spreads. And there are a whole bunch of different kinds of credit spreads: mortgage-related products, structured products, credit, investment-grade credit, high yield, convertible bonds, emerging markets. So for investors that have the capability to invest in these assets, there's a great way to build a yield. So you can build an additional yield premium into your portfolio, but also diversify those premiums and go where the value is. So that's what we like to do, and we think it makes sense in any environment. It just so happens in today's environment, it's highlighted very distinctly by the fact that the key risk factor, which drives a lot of the higher quality benchmarks, is really, has been a big risk in a deterrence performance. But we always like to diversify away from that anyways.